Welcome to the Intermarket Analysis Update. This is a video that I do every week where we look outside of the S&P 500 at other indexes. We look at some ratios, we look at valuation, growth, number of different areas, just to get some insight as what is happening in the market overall. And not a lot of changes this week, but I'll still go through these areas to see that a lot of things are pretty much maintaining the same levels if you watched this video a week ago. This is being prepared for Monday, June 16th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. First of all, I'll go through valuation, both on a historical basis, looking at previous earnings reports, comparing it to the price of the S&P, and then we look forward. And I'll go through a pretty extensive look at growth versus value. When the market's more positive, we see growth outperforming value. Then we'll look at inflation and see if that's becoming any kind of a concern. And then we look at some other markets outside of not only the S&P 500, but also the stock market, just to see if we get some insight there. Then we look at the 11 sectors of the S&P 500 and then compare them to the S&P 500. We go through a lot of different indexes that we follow to get some insight. Then correlations between different markets, some very long-term trends. And then finally, at the end, I come up with a list of those things that are positive and those things that are negative. The first area is valuation. And as we've been for the last 2 or 3 years now, we are overvalued. Now, this chart looks historically back at previous earnings reports. The black line is the S&P, and then we have a red dashed line, blue dashed line, green dashed line. And what this does is it gives a price to earnings ratio. And when we're at the green line or below, the market is considered to be inexpensive. And we don't spend much time down in that area. Then we look at the blue dash line, which is considered to be fairly priced. That's at 15. And then when the market's at 20 or above, it's considered to be expensive at that point. And we've been above this dash line for quite some time. In fact, I have a study down below that compares the current PE with price and how far above zero we are. So on a historical basis, we're still considered to be expensive. This is that same basic chart, but it goes back to 1980 and then different events that happened along the way and what the valuations were at that time. Then Robert Shiller developed a variation of historical PE ratios by smoothing out previous earnings, and his reading is coming in at 36.52. Well, you can see by the chart that we've been going up and up and up for quite a long time now, and you can also get historical perspective going back to the 1800s. The median and the mean is what I generally use as far as are we really overvalued right now, and we're coming in between 16 and 17 with the current price of 36. So yeah, even looking at it this way, we are expensive, but we've been expensive for a long time. This is what the market really focuses on, though. These are forward-looking PE ratios put out by analysts, and these are projections. And based on what the current price is, given what future earnings look to be, and we're also overvalued here as well. Now, this purple line is the Mega Cap 8, coming in after Friday's close at 27.6. We're way above that 20 level, but we've been above that 20 level consistently for a number of years now, and the market doesn't seem to mind that. So I don't use these charts as some kind of timing mechanism. We just look at them to say, okay, what's the overall condition of the market? Because it's pretty much overvalued all the time, so we don't want to make our decisions on that, but it's still a really good thing to know. Now, the line that I pay most attention to is the S&P 500, which is the red line. It's coming in at 21.3, still above that 20 level. Then we get down into the fairly priced area, but these are two areas of the market that have really struggled. These are mid caps and small caps. Their PE ratio looking forward is lower, with the mid caps coming in at 15.7. That's more fairly priced. Small caps at 14.7, but they just haven't been performing well. In fact, both of these indexes, the mid caps and small caps, are still under their 200-day moving averages, where the S&P 500 is above its 200-day moving average, even though it's still in a downtrend for the current time. All right, then this looks globally. And you see the black line? These are the valuations of the US. And this is price and then the 10-year average of earnings. So it's similar to the Shiller PE ratio. And then you can have emerging markets, which are in red. And we have foreign markets. I believe that's FM. I'm not sure about the foreign markets. And developed markets taking out the US. And how the US market is more overvalued, but it's been that way for a long time. Okay, growth versus value. First of all, we look at just growth all by itself, still in a downtrend, but we're seeing where the 50-period moving average is coming up to the red line, and we're above both moving averages. So since the April lows that we set, we've been coming up out of that, kind of slowing down as the market's been slowing down lately. Then, of course, we had the down day on Friday, but this is improving when you look at it all by itself. Or value is in a downtrend, also improving, but not seeing the upward thrust of strength like we've been seeing with growth. And that's more positive for the market. Where we really get the insight is when we start looking into ratios between growth and value. And on the top, we have growth versus value. That's holding up quite well. And then an inverted version of that same ratio shows how value is underperforming growth. And then in the charts after this, we just look for confirmation. We look at a number of different ratios between growth and value. This is a growth ETF versus a value ETF, showing how growth is outperforming. Here's an inverted version of that same study, showing how value is underperforming. Then we look at some indexes. Growth is holding up quite well here. Value is underperforming here. So that's more positive. Then we look at a growth versus value ETF. Still looking good, above most of the rainbow that we see on this chart. This is that same study, but inverted. Value's been underperforming. Then we break it down a little bit more. We look at small cap growth to value. Still holding up quite well, even though the small caps haven't been doing all that well. They have little spurts to the upside, and then they end up giving back a lot of those gains. But the growth to value ratio is still looking pretty good. Also, still looking pretty good with the mid caps, even though the index itself has been struggling in 2025. This is the one that I probably focus on the most, is the end of day S&P growth to value ratio. We just generated a recent golden cross here. We've been falling back lately, and we got hit on Friday. We'll keep an eye on this, but this is still holding up for the time being. Then keeping an eye on inflation, this is very long term. This is the CRB index, a monthly chart, where we're above an advancing moving average, which shows some slight inflationary potential there, because these are commodities. And when they go up in price, they ultimately flow through to the consumer, which sees an increase in price as well. Now, what we're seeing down below is inflation versus deflation on a ratio basis, monthly chart. We're, for the first time in quite some time, we're starting to break above the moving average. So this could be somewhat inflationary, but this is a monthly chart, and we're just about halfway through the month. It won't update until the end of June and be completed, but we'll just watch this and see if that's causing some kind of a concern. Then we have the CRB index. This is a daily chart, which it shot up. Now, a lot of that in Friday's session had to do with oil and gold, because we have geopolitical events that are unfolding. There's also domestic events in the US, but the geopolitical events are the ones that really impact the stock market more. And it's really going up, still in an uptrend. We were getting close to a death cross here, but we're not quite there yet. We look at the Baltic Dry Index, which is also going up. Typically, in a general sense, when this is going up, that's more inflationary. It costs more to ship products, specifically in the Baltics. And we're in a downtrend, but we could see a golden cross here pretty soon if this continues to go up. Then these are inflation expectations, a weekly chart, where actually, according to this chart, we've been coming down after spending a lot of 2025 going up. It's actually starting to decrease a little bit. So this is a bit of a contradiction to what we've been seeing with the commodities. Then we look at a ratio between inflation expectations, the previous chart, and TIPS, Treasury Inflation Protected Securities. If folks are worried about inflation and interest rates, they get into TIPS. If they're not, then they don't get into TIPS. They get into longer term government bonds because they think interest rates have topped out. They can get into that bond and then have the duration of that yield that they get for however long the bond is. We're actually seeing this ratio coming down a little bit. So this is suggesting there's not a lot of fear about inflation according to this chart, even though we're seeing some inflationary pressures in the CRB index. And some other markets, here's aluminum, which still continues to be in a downtrend. That's not inflationary. Corn is in an uptrend, but it has continued to pull back. Wheat continues to be in a downtrend, but it's been bouncing up. And fertilizer has been declining, as well as lumber still barely in an uptrend, starting to bounce back up a little bit, but not really showing any real inflationary fear, at least yet. Now, oil, this is what we watch not only for the price of oil itself versus supply and demand, but for geopolitical reasons. And we actually got down into the high 50s there not very many days ago. Well, then it started to creep back up. It got back into the 60s, then the mid 60s, and then in Friday's session, it surged up into the mid 70s. We'll keep an eye on this as things continue to unfold in the Middle East between Israel and Iran. We'll see if oil continues to go up. Iran controls the Strait of Hormuz, which a lot of oil comes out through that area. And if they block that, that could really send oil prices up. Then a gold to oil ratio, where this is going down because oil really shot up more than gold did. So we're coming down a little bit here, but overall, gold has been outperforming oil. Then we look at some correlations. The oil, which is the red dashed line here, which did go back up, and then looking at the 10-year yield, which is also going up here. We're still pretty much neutral, though, with this correlation, even though it's starting to come down a little bit. The further we go down with a correlation chart, the more they're going in opposite directions. If we get a very high reading, that means they're going in the same direction at the same time, either up or down. And gas, it really spiked up here, and probably a lot of us will feel that because we see gas prices going up. It's still in an uptrend, but we're seeing the blue line trying to cross down below the red line. Heating oil did go up as well, but it's still in a longer term downtrend. And natural gas is in an uptrend right now. Diesel, not really spiking up all that much. It's really been declining in the bigger picture lately. And copper, and this I use as more of a barometer of the economy. When it's in an uptrend, that generally means a brighter economic outlook. And copper's been doing okay. It was down over 2% on Friday, but it's still in an overall uptrend. And then a copper to gold ratio, which still continues to decline. We've been seeing that for many years now. It's denoted by this longer term chart. The black line is the copper to gold ratio, and we've been kind of higher but leveling off here as far as the 10-year yield. We have been declining a little bit with the 2-year yield. Typically what was happening from 2012 up to about 2016, we were seeing all of these going in the same general direction. And we've seen quite a divergence here that's been lasting for the last few years. Pretty much since the COVID lockdowns and everything started to kind of stabilize after that, they were generally going in the same direction. And then once we got into 2022, which was a cyclical bear market, we saw this ratio really coming down as interest rates were starting to go back up. And gold, not at an all-time high here based on, it could be, it's kind of hard to see that, but still holding up quite well when we look at the ETF. This is not the futures contract. I just follow the ETF. And silver, which really has been going up here, it fell back a little bit, but it's in an uptrend as well. Then we look at a gold to silver ratio based on the closing price of gold and silver. When this is going up, that means gold is outperforming. Lately, Silver's been outperforming as this ratio has been going down. And then we plot the US dollar index. This tries to look at the relationship between precious metals and currencies. And it's a pretty strong correlated relationship right now. This ratio's overall been going down as the dollar's been going down as well. The dollar, which is in a downtrend below its moving averages, we're clearly in a downtrend here as we're dropping into the 98 range. And the euro's been going up as the dollar has been going down, and the Japanese yen has been going up as the dollar's been going down. Then I break these out into individual charts. This is the euro against the dollar. This is the yen against the dollar. Not quite as strong lately, but still in an uptrend compared to the dollar. And then the British pound, which has been going up compared to the dollar.
Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you.
Then we look at some different indexes. We have the weighted version of the S&P 500. That's the regular index that everybody follows. And the bigger stocks have more of an impact. If they're having a good or a bad day, that will drive the S&P 500 up or down. Well, to make it a little bit more fair and to give us a little different perspective, there's also an equal weight version of the S&P 500, which treats all the stocks with the same weight for how it's calculated. We're seeing a bit of an underperformance here. Now, that's kind of on the negative side. That just means that the red line's further below the bar chart here, even though they're on different scales. But when they get kind of far apart, and especially when we see the S&P going up, that means the bigger stocks are having more of an impact on what's happening with the index. That means there's not as much broad market participation. That's the negative side. The positive side is it's the bigger stocks that really drive the index. So if they're outperforming, that's when the index tends to do better. So there's a positive side and a negative side. This is a different way of looking at that. The equal weight to S&P 500 ratio, and this is going down. That means the equal weight is underperforming. And that's what we've been seeing now over the recent past. Then we look at a ratio between stocks, the S&P 500, and commodities, the CRB index. And stocks have been bouncing back up, but especially in Friday's session, we saw a bit of a reversal there. We'll keep an eye on that to see, is this going to change longer term, or was this just more of an emotional reaction to what's happening geopolitically? This is that same ratio, but flipped upside down, showing how commodities have been underperforming, but did spike up on Friday. And we look at the NASDAQ 100, which is growth, and compared to the S&P 500, which is growth and value. And this is more positive when we see the ratio going up. And we're in an uptrend here. So that's more positive for the market. The S&P 100, which are the biggest stocks that make up the S&P 500, this is also more healthy when we see the 100 outperforming. The NASDAQ continues to outperform the S&P 500. Typically, the NASDAQ is more growth, where the S&P are more established companies consisting of growth and value. But when growth, that's more of a risk-on type of measurement here. And so this is improving. The NASDAQ 100 is kind of leveling off when we compare it to the NASDAQ itself. When the NASDAQ 100 is really outperforming, that's typically more positive. But ever since we went down in late March and into April, this ratio has been leveling off some. Then we look at the mega cap growth. These are the really big stocks. They're in an uptrend when we compare it to the equal weight. And this also shows that the real big stocks they're at least trying to continue to establish more of a leadership role, which could be more positive for the market. And small caps, which continue to underperform the S&P. Here's another study. The red line is that same ratio, how it's been going down overall, where the blue line is the S&P, and that's been performing much better. Small caps to tech. Small caps are underperforming the tech sector as well. And mega cap growth was down in Friday's session, but still above both of the moving averages. Starting to see the moving averages turn back up. So this is still holding up for right now. Then robotics and AI ETF just coming back up and chopping along sideways inside of the rainbow. But when we do a ratio of the robotics and AI ETF to the tech sector, you can see that the robotics and AI ETF is underperforming. Now, I have another index that I follow for this later that I'll show. This is the Dow Jones Composite Average, which is the Dow, the transports, and the utilities together. Just kind of chopping along sideways, a little bit under their 200-day moving average with this overall measure. And then the semis to tech. Now, this is an area we want to keep an eye on. When this ratio is really going up, as it was earlier on, that really can be some strength for the market. We want tech to do well also, but we want semis to do even better. When semis are doing better, the ratio goes up, but it did fall back in Friday's session. Low volatility stocks, these are more defensive and they're just kind of chopping along sideways. Just think of like toilet paper and toothpaste, things that people have to have. These are also considered staples as well, but still in an uptrend, but not really seeing any explosive growth to the upside. If this was really moving, the market can still go up. As we saw back in 2024, we were in a solid uptrend, but the S&P was doing very well itself. It's when these really start to go up and the growth stocks start to go down, that's when the market's getting more defensive. We look at a ratio between the low volatility ETF and the S&P, still underneath both of the moving averages. This is more positive as this ratio declines. And we look at energy to tech, which we did see a spike up. Energy went up on Friday, tech went down. That's why we're seeing this ratio going up. But overall, in the bigger picture, we're still seeing where energy is underperforming tech. The tech sector to the 10-year yield ratio, showing how we're in a downtrend here, but tech has been coming back up as it's trying to come up out of the April lows and actually taking more of a leadership role in the tech sector. This is that same thing, but inverted, showing how the 10-year yield is now starting to underperform as we've been recovering from that decline that we saw earlier in 2025. Growth stocks still holding up quite well when you compare it to government bonds. That's more positive, just seeing a recent golden cross with this ratio. Discretionary to staples, this has been lagging a little bit. We have been improving, but then we've been going along sideways. And this includes stocks like Tesla, Amazon, the things that make life fun. That's been struggling a bit lately when compared to staples. This is that same thing showing how staples have been underperforming, but the whole ratio continues to chop sideways. Gold, which was really outperforming, it was going up as the S&P was going down. Now we've seen that fall back a little bit. And then the dollar's been going down as gold has been going up. So not a real surprise there. And then we look at US versus world stocks. This looks at the US and then compares it to stocks in the rest of the world. How US stocks continue to underperform. And at best, we've been just chopping sideways with this ratio. Now, this just looks at the global stocks all by themselves. So you can see, doing pretty well if you take out US stocks. But then when you add it back into the mix, this ratio really starts to go down as US stocks have had a more difficult 2025. Then here's the advanced decline line studies across all the indexes that we follow. Even with the declines that we saw, specifically in Friday's session, we're still above the moving averages with the NYSE common stock, S&P mid caps, and small caps. And the Dow to transports ratio, when this is going up, the Dow's outperforming. It was starting to fall back, but we've kind of been chopping sideways with this ratio. And the transports, not really going anywhere. They're kind of like the small caps in a way. They have some improvement and then they fall back and chop sideways and maybe a little improvement. Now they've been falling back lately. Then we look at a ratio between the transports and the S&P, showing how the transports are underperforming the S&P 500, but the correlation, even though they're underperforming, it's still fairly strong down here. We're getting a pretty high reading when we compare the S&P to the transports. Then this is traditional Dow theory developed by Charles Dow back in the 1800s. where you look at the Dow and the transports. Those are the two basic components just to see if they're confirming each other. But we've been seeing kind of a negative divergence for quite some time. The Dow's been doing better. The transports have been improving, but then chopping along here and not setting all-time highs. Where the Dow recently set all-time highs not too long ago. So that's still a negative divergence that's in the background. Now, I also include utilities as part of Dow theory. And even though we've been chopping along sideways, the overall trend of utilities has been to go up. Then instead of using the old way of looking at Dow theory, the idea is to replace the Dow with the S&P, thinking that that's a better representation of the US stock market. And instead of using the transport, since we're a technology-based society now, let's use the NASDAQ instead. Not really seeing any major divergences right now. They're both going up and down more in tandem. We can further break that down by using the equal weight version of the S&P, which I like to point out from time to time. Even though we set an all-time high in February with the S&P, we did not set an all-time high with the equal weight. So that's a little bit more of a negative divergence that's in the background. And then instead of using the NASDAQ, we use the QQQs, which is the NASDAQ 100, and then use an equal weight version of that ETF. And we're not really seeing any real disconnects or major divergences currently. The FANG index, this has been doing quite well. It got hit on Friday, but we're in an uptrend. And these are the bigger stocks as well. Facebook, Apple, Amazon, Netflix, Google. This has actually been holding up pretty well. And the Wilshire 5000, which is a broad market measure, still above its 200-day moving average. And then this is another broad market measure, the total U.S. stock ETF. It's doing okay for the time being. ARK, which is trying to get back up to an uptrend here. It was actually up a little bit in Friday's session. The NYSE Composite, which is holding up better. This is more of a broad market measure. It got hit with everything else, but it's been holding up better than some of the indexes. It's a little less volatile. High leverage loans, still looking really good here. This is another barometer of the economy, and it's in a pretty solid uptrend here. These are very risky loans, and as long as this is continuing to do well, that suggests that there's more positive economic outlooks down the road. Then all stocks, where we look at U.S. and international stocks, really a lot of the strength from this chart has been coming from global stocks or international stocks, not so much from U.S. stocks. Emerging markets are in an uptrend as well. Bitcoin is in an uptrend. The micro caps in a downtrend, but trying to improve after getting hit like everything else earlier in the year. Then the semiconductors, which are in a downtrend, the blue line's still below the red line, but we're above both of the moving averages. This is a major area of growth. And if these can continue to improve, that would really be more positive for the market. This is that same ETF, but using a rainbow study here just to show that we're above most of the rainbow. Then this is the other AI and tech ETF. This is looking more positive than the robotics and AI ETF. We're just about ready to see a golden cross here. That could switch this back up to an uptrend, and this has been improving a lot better. Then we want to keep an eye on the home builders. They've been under a lot of pressure, and that gave us a little bit of clue back in late 2024. We saw the home builders really start to underperform the S&P, and that was a warning sign, and that kind of led us into 2025. And we keep an eye on the correlation, pretty strong right now between the S&P 500 and the home builders ETF. And then just for international purposes, we look at the Japanese Nikkei index, which still just is chopping around, not really going anywhere these days. Then we look at some longer term trends of different markets in the world, where China is pretty much flat. We're starting to see a downtrend here in emerging markets as well as Europe. Japan is rolling over and looking negative, and the US is looking a little more negative. So in the bigger picture, we're looking a little bit more negative according to this chart. So that could put some pressure on stocks. Then this is another study between US and global stocks. We came all the way down to the moving average. We're a little bit below it right now. And that just shows how global stocks have been outperforming US stocks. We also look at the PPO, which is a momentum oscillator. It continues to decline and is below zero, just confirming what we've been seeing with other charts that global stocks are outperforming. Then we keep an eye on bonds. This is just the 10-year based on price. Now, in the daily video, I focus more on the yield. In this video, I tend to focus more on the price of the 10-year bond, which is in an uptrend measured by the MACD, and we're still above 50 with the RSI. Total bond ETF continues to be in an uptrend. These are bonds based on price. And then we're only halfway through June, but this is a monthly chart of the stock to bond ratio, which really took a hit as we were coming down. Now it's continuing to improve. And this is a daily chart showing the bond to stock ratio, where when the S&P was really going down, this ratio was going up. Now that the S&P has been recovering, this ratio is going back down and it still continues to decline. The Prime World Bond Index is in an uptrend, and the corporate bond index in a downtrend, but we're above both of the moving averages here. So corporate bonds based on price pretty much in a range lately in 2025. Then this is another way of looking at investment grade bonds, which are more conservative. They're holding up okay, even though they're still in a downtrend. The blue line is slightly below the red line, but we've been just pretty choppy with this index. Then we have junk bonds, which continue to do quite well and are in a more established uptrend. And so folks are willing to get into junk bonds. They're willing to take on that risk that a junk bond can bring because they're high yield because they have a lower rating. And so they're riskier, but in order to justify that risk, they give a better yield or a better interest rate, and folks are still favoring that. And we look at a stock to bond correlation, pretty much neutral right now. Starting to get a little bit stronger with the correlation, but not out of the neutral band that I have here. And we're just kind of chopping along. When we look at riskier bonds, junk bonds versus more conservative bonds, we have been improving overall, but we're not really seeing any real upward thrust according to this study. Then just showing the overall range of where we've been going back to 2022 with the 10-year yield. And these are junk bonds by themselves, which are holding up quite well. We do a junk bond to government bond ratio. Junk bonds continue to outperform. This is a daily chart just to give us an idea. Are yields going up or down across different maturities? Then a weekly chart of international rates here. And for the most part, interest rates have been coming down globally. We look at the volatility of bonds on top as measured by the boom index. That has been declining. Now we went up above 20 with the VIX, which measures the volatility of stocks. We did that on Friday, but we're still below the moving average, which is coming down, but not a real strong correlation right now between bond and stock volatility, although it is getting a little bit stronger. Then we do some ratios between stocks and bonds. The S&P 500 was short-term bonds based on price, still above the rainbow. And you're going to see that a lot through these charts here. We've been seeing this now as stocks have been recovering. The S&P 1500, the short-term bonds, still holding up fairly well there. Then another broad market measure with further out bonds, 3 to 7 years out, just showing that we're still above the rainbow here. The tech sector holding up well with 3 to 7 year bonds. And this is an inverted ratio here. Bonds to stocks. When we're going down the way we have been, that means bonds are underperforming stocks. When stocks were really declining, this ratio was going up. Now that stocks are going back up, this ratio is going down. Then the S&P 500, the 10-year yield, just kind of chopping along sideways right now, but it is in a downtrend. And then we look at a monthly chart. This is the long-term bond, 30 years, based on price, where it's still declining and below the moving average, which is declining. And then on the bottom, we have a bond to commodity ratio, longer term, which shows that this is also going down. The price of the long-term bond is starting to be in a more downward momentum compared to commodities. Then we look at the 11 sectors that make up the S&P. We look at materials, which is more cyclical. They got taken down with everything else, but they're having a really difficult time getting back above their 200-day moving average, and they are still in a downtrend. And underperforming, when we do a ratio between materials and the S&P, Communication, this is a growth area, and this has been holding up quite well. It got hit over the last few days here, but when we compare it to the S&P, it's continuing to outperform, even though it's leveling off. After we started to come back up and we haven't been trending with the S&P, this ratio has been going sideways quite a bit as well. Then energy, which really went up in Friday's session, back above its 200-day moving average, but the bigger picture is this continues to be in a downtrend, but it has been improving. And we're in a downtrend when we compare energy to the S&P on a ratio basis. Even though, and you can see, going back even before Friday's geopolitical events unfolded, this ratio was starting to go back up. And so oil prices were beginning to climb up in anticipation of something possibly happening. Now, earlier on, last week, I mentioned that OPEC Plus came out and said, we're going to produce more oil in July. That usually makes oil go down, but it was still going up anyway. So it could have been some fears about geopolitical events. And the financials, and we're keeping an eye on this. I'll show you the next chart here, but we're still doing okay. And this is still one of the better looking uptrends that we've seen. And that's more positive if the financial sector is doing well, but really not looking all that good. I've been showing this chart in the daily videos because we're coming all the way down to the 200-day moving average with the ratio of financials to the S&P. And it's like this has been dropping off here. And what's going on? We're not really seeing anything in other charts. Some of the other charts that we look at that have to do with the financial sector, they're looking okay for right now, but we are seeing an underperformance. Is this just more short term and it's going to improve? Or is this trying to give us early warning signs that maybe something is not looking as good in the financial sector? And industrials, which are just starting to generate a golden cross now by themselves, and looking pretty good and doing, it's been one of the better performing areas in 2025 so far. Even though it's been pulling back lately, it's still in a longer term uptrend with the ratio. The tech sector, this is the big growth area. Even though we're in a downtrend, we're seeing both moving averages starting to turn back up and in a downtrend when compared to the S&P, but above both of the moving averages with the ratio. Staples kind of chopping along sideways, not really breaking out or breaking down either, in an uptrend when compared to the S&P, but falling down below both of the moving averages. And that's more positive. This is toilet paper and toothpaste, and when these are underperforming this way, that means that the market is getting more offensive or risk on rather than risk off. Real estate just kind of comes and goes with whatever's happening with interest rates, still dancing along their 200-day moving average and underperforming and just about ready to generate a death cross here when we compare it to the S&P. Utilities just kind of chopping along sideways. They see little moves up as well. They're still in an uptrend by themselves, but kind of going sideways recently when we compare it to the S&P itself, even though the overall ratio is in an uptrend. Then here's another look, and I use this to determine what's performing better. When this is going up, that means the S&P is outperforming utilities. When this is going down, that means the S&P is underperforming utilities, and it's more positive when this ratio is going up. Then healthcare, again, another defensive area in a downtrend, although it has been clawing its way back recently. But when we compare it to the S&P, not really doing all that well in a downtrend. Discretionary, chopping along sideways here in a downtrend all by itself, and underperforming, just kind of chopping around, not really getting much of a trend right now when we compare it to the S&P. Semiconductors, a huge growth area, still in a downtrend, but above both of the moving averages. And the Dow Jones Semiconductor Index also improving. And then a longer term chart, a weekly chart of the SOX index, which are semiconductors, still looking pretty solid here. And then we do a ratio between semiconductors growth and the Dow, which is value. And we're trying to break out of this series of lower highs here. And we were improving. Now, we were down on Friday, but if this ratio could continue to go up, that would be more positive for the market. Then the intermarket analysis chart shows the gold's up over 30% so far for 2025. And then oil, the red line, that really shot up in Friday's session. We're seeing commodities going up as stocks are going down. And then we're seeing the dollar is the worst performing asset in 2025, and bonds have been under pressure a bit as well. Then correlations between the S&P and the dollar coming back up into neutral territory now. The dollar's been going down as the S&P's been going up, and that's usually positive. The stock market likes a weaker dollar, but now as stocks got hit on Friday, it's changing the correlation a little bit and coming up into neutral territory with this one. The S&P to oil, we were seeing a pretty strong correlated relationship. Now that's starting to drop off. Then the S&P to the 10-year yield coming back down into neutral territory, and the tech to 10-year yield also coming back down into neutral. Then stocks to shorter term maturities like the 2-year yield, they were going in the same basic direction, now starting to come back down. All right, then some long-term trends here. This is the NYSE Composite, a monthly chart. Still looking pretty good here. And we're only halfway through June, so there's still more to go. But when we look at the momentum of the uptrend longer term for the NYSE, the Copic curve actually is going down and starting to bounce back up a little bit here. Another monthly chart of the NYSE. This is the NYSE record high percent index. It was really coming down with everything else. We hit the lows and it's trying to bounce back up. Then another monthly chart of the NYSE, still above the moving average. And this is from a week ago, so you can't see there's much of a change there. And this is the current chart here. The S&P 500 monthly chart, still above the moving average, but the PPO, another momentum oscillator, starting to level out after it had been declining for pretty much all of 2025. And then a monthly chart of the S&P on top, and then a stock to bond, excuse me, a stock to commodity ratio here, showing how this ratio, the momentum, has been coming down. Then another global look here, longer term, coming right down to an advancing moving average here, but the KST, another momentum oscillator, continues to decline. So there's been some damage and some things that we'll keep an eye on. But for right now, things are trying to improve. We'll see how much this geopolitical event between Israel and Iran, how long that is carried out and what kind of an impact it might have.
With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial.
So then at the end here, no changes if you've been watching this. We still have the same positive list that we had a week ago, with copper being in an uptrend, the euro, the pound, and the yen all against the dollar. The CRB index, gold and silver. The low volatility ETF by itself is still in an uptrend. Staples are in an uptrend. And then bonds based on price. The total bond ETF, high yield, investment grade bonds, junk bonds, world bonds. The only thing in a downtrend right now are corporate bonds, and that's on the next slide. The FANG index, and that's more encouraging. These are the really big stocks. The high leverage loans, that's good for the economy. Emerging markets are in an uptrend, and Bitcoin is in an uptrend. Then the negative side are both the growth and value indexes when you look at them independently, but they're both above their moving averages, especially growth is. The mega caps are improving, and the dollar is not improving. It's been really having a difficult time. Corporate bonds are in a downtrend. The Dow Jones Composite Average, which is the Dow, the transports, and the utilities. Tech sector improving, but still in a downtrend. Semiconductors improving, but still in a downtrend. And then all the different main indexes that we follow, the Dow, the NASDAQ 100, NASDAQ, mid caps, small caps, the S&P itself, all of these are still in downtrends as measured by moving averages. But except for the mid caps and small caps, and even the micro caps, we're above both of the moving averages. So there is an improvement that's happening. And then the NYSE Composite, which is actually holding up a bit better than some of the other indexes, and our broad market measurements that we look at, the Wilshire 5000 and the total US stock ETF. They're in downtrends, but improving. And then ARC is trying to improve as well as all stocks. That's US and international stocks together. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.